Come on in, sit back and relax. You're listening to episode 228 of the WealthTech Today podcast. I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. This podcast is all about the news, information, updates, technology around wealth management. You are going to love this episode. It's our February news, and we've got a lot of stories to cover, so I'm going to dive right in. And plus, we have a special guest. I'm going to tease that. You won't know who it is until this person comes in later in the program. We've got a lot of stories. Let's see, I got 10 stories, plus our monthly review of the AdvisorTech map, which you all know and love on Keatsis.com, that I work on with Michael Keatsis, and the WealthTech integration scores go along with that. So, kicking off our news this month, we have a lot to cover. First is 3 stories on integrations. We're going to roll them up together. 3 firms announced some impressive integrations, and as you know here at Ezra Group, we love integrations. Bring them on. First one is FP Alpha. FP Alpha announced integration with Orion Advisor, and this new integration pulls client information and data from Orion into FP Alpha, into their general questionnaire that is used to power their tax and estate snapshots. So FP Alpha has a couple different functionalities. They started with estate planning, and they then launched a tax, not tax planning, but a tax management service that can take in PDFs of your tax returns and provide advice on those. And they have their estate snapshot. And this integration is a wider trend of prioritizing advisor workflows and focusing the tools which they believe will save some time. They also claim they're incorporating some AI technology. So I haven't got the details on that. Of course, they use some AI in their when they're evaluating the PDF files that they're uploading with their estate planning documents or tax returns. There is some natural language processing, OCR, that utilize some AI capabilities there. FP Alpha updated a new suite of estate planning, or released a new suite of estate planning upgrades at the T3 conference last month. Oh, and we're also doing a bit of a T3 update at the end of the news. Now, let's see. There's some other integrations from FP Alpha. They've been doing a very good job building out integrations. The most recent one was with Precise FP. Our second integration update is from Tiffin. Tiffin announced an integration with BetaNext and Franklin Templeton. Now, Tiffin has a number of platforms and products. If you can check out my interview with Vinay, the CEO and founder of Tiffin, a couple episodes ago. That was a really, I think, very interesting and enlightening episode. Now, this is the Tiffin AMP platform, spelled AMP, which is their asset management platform, which can now be leveraged alongside BetaNext's data ecosystem. So I was a little confused about how this exactly worked. This collaboration will allow asset managers to leverage BetaNext's data ecosystem in cooperation with their wealth management clients, so enabling significantly more precise fund distribution efforts. So I see Tiffin AMP as giving some advice to asset manager wholesalers and giving them data on the advisors who are using their asset management models and other intellectual property, and helping them decide which advisors would be best to sell their asset management products to. There's some integration into CRMs and marketing automation systems, and there's a comprehensive platform that combines marketing, distribution, and AI sales support signals. Now, I can't speak for how well their AI generates signals, but I've seen a demo of Tiffin AMP. The interface looks really good. I like the UX and experience, and they provide signals that tell the wholesalers, hey, these advisors will be most likely to be interested in the particular strategies that you are selling. So they believe they're going to transform wholesale distribution efforts into actionable strategies and providing precise insights across various investment products as well. Now, the second part of the announcement is Tiffin and Franklin Templeton. I spelled Franklin wrong. Franklin Templeton, who is a global leader in asset management. Now, they've joined forces to create something called Tiffin at Work, which is a white label solution for plan advisors to deliver an AI-powered actionable advice platform for workplace benefits and financial wellness. That's an industry term we've heard a lot, buzzword, financial wellness. We hear that thrown around a lot, not really sure what it means. In the past, it had meant some very simple advice, really just algorithmic advice or rules-based advice. And we had built some, we had helped some firms build out some of those capabilities over a dozen years ago, and they were more just rules-based, where if the employee said, "Hey, I haven't saved anything for retirement," well, the rule would say you need to save something. So, do you have an employee match? Yes. What's the employee match? 6%. You should max. Right? That's the default. You always want to max your. The recommendation is always to max the company match in your 401k. So simple rules like that. What we're seeing now is more advanced capabilities, more AI powered, more machine learning really powered, that take more data into account about the employee and give a little bit more precise recommendations. Of course, they're calling this a holistic AI powered platform. I haven't seen a demo of it yet. I'd really like to see how they adjust their benefits to achieve better financial outcomes, better than what we were doing a dozen years ago with just some simple rules. Because again, most employees in these types of plans don't have very complex financial lives, and even if they did, it's very difficult to gather that kind of information in these financial wellness platforms. But we're still happy to see these type of capabilities being launched. The more options available for corporations and for advisors who service those corporations, we feel is better. Our third integration story of this month is Altruist. Altruist announces 6 more integration partnerships. So it came out with a bevy of integrations, including Orion, Redtail, Quanti, Investment Money Guide, Income Lab, and eMoney. So those are new integrations joining their existing integrations. And I'm reading ahead here. Well, of course, we know that disconnected tech is a massive pain point. We like to see more integration, reducing duplicate data entry, reducing manual recon, reducing inconsistencies that are going to show up in your client reports and billing and make them unhappy. So these types of integrations are we're excited to see them. There wasn't any data on exactly what data they're passing back and forth. And that's something that we will dig into in our integration score. So when we update the Altruist integration score, which you can find at EzraGroup.com, if you go to our website, EzraGroup.com, and you click on the menu option, what we do, and then click on WealthTech integration scores, you can check the score of any company. You can check on Altruist, which I'm doing right now. And once you click that, it'll show you that Altruist has a score of 3.43, which is not so great, but this should hopefully increase that score with these 6 integrations. Again, our score is based on the robustness of the integration, not just the raw number. Because as we all know, an integration can be something as simple as a single sign-on is considered to be an integration by some, all the way up to a bi-directional embedded widget that would be a much more robust and higher scoring integration. All right, so Altruist had a number of other announcements. In September of last year, they eliminated their portfolio accounting software fees for all brokerage accounts. That's nice. I think it was $1 an account. Still, it all adds up. The fee reduction and integration follows a larger push from Altruist to reduce friction, another buzzword, reduce friction and improve the user experience. Last year, the company also increased their ACH limits, added reporting tools, and made several UX, UI improvements. There's a couple other things coming down the pike for early this year. They're going to add additional integrations with Smart RIA, Morningstar, and Bile accounts. So now that's really all I have for integrations. So if you want to look up more information about these companies, you can go to altruist.com, you can go to tiffin.com, and you can go to fbalpha.com. Now for our next story, Addepar surpasses $5 trillion of client assets. Now, Addepar is a wealth tech provider, mainly reporting solutions when they first started out and data aggregation, but they've since expanded their capabilities tremendously to become basically an end-to-end wealth management platform. Now, Addepar was founded in the wake of the 2008 financial crisis by Joe Lonsdale because he saw the trouble his own family office was having when trying to produce consolidated reports for his non-publicly traded investments. Now, this timing was fortuitous, as a number of trends have pushed more advisors to move beyond traditional stocks and bond portfolios and into alternatives. So first, there was an increase in the number of startups deciding to remain private. Part of that is due to Sarbanes-Oxley in greatly increasing the complexity and costs of going public. And combine that with a steady pace of public companies being taken private, which resulted in a drop in the number of publicly traded companies around. So investment dollars have to go someplace. If public companies aren't available, then it's logical that advisors wanting to get exposure to private companies that would have been public in a private era, in a prior era. The second trend is one of the driving forces behind the economy's shift into private markets was the explosion of private equity, which has attracted an attention of a wider group of investors who are chasing outsized returns. And third, zero interest rate policy, or ZIRP, which is no longer in existence but was for quite some time, pushed by the Fed after the financial crisis, stayed around for much of the decade of the 2010s, and publicly traded bonds became a drag on portfolio returns. So all this drove more money into alternatives. Enter Addepar with an approach which was different at the time, that they wanted to build a platform to track every asset, whereas most wealth management platforms focus just on publicly traded ones that are available at custodians. Addepar was looking to support basically a wide range of assets that would be more likely to be held at higher net worth firms and higher net worth clients, including private equity, real estate, plus alternatives, credit derivatives, options, foreign equities, private company holdings, you name it. So Addepar did a very good job in building their data feeds and building their import routines to gather that information, but also in their front end that enabled advisors to view in-depth underlying information about all these assets. They have a lot of customized attributes available for things like private equity, like call dates and call amounts. So having that data about those different investments is critical when you're an advisor managing what could be across dozens or hundreds of investments. So Adepar's reached their $5 trillion in assets, serving over 1,000 client firms across more than 40 countries, with 30% of their clients being outside the US. Now, they've got a robust set of APIs, which we like, in a partner ecosystem that allows clients to tailor solutions. Now, out of that $5 trillion, what did I say? So 60% are in marketable securities and 40% are alternatives, which was surprising to me. I thought it'd be the opposite, but it's those 40% alternatives and the complexity of them that gives Addepar some of its differentiation, as well as the strength of their reporting solutions, in that a lot of firms are willing to pay up for Addepar because they're more expensive because of how well designed their reports look. Addepar brings in positions and transactions from more than 7 million accounts across more than 350 global banks and other financial institutions. What's significant about Addepar hitting 5 trillion is it gets them up into the ranks of the top firms in the space. Orion is around 4 trillion. InvestCloud, which has got the old Fiserv APL platform, is around 6 trillion, and InvestNet's way over 6 trillion, probably 7 trillion by now. So that puts Addepar into that same category. And that's really what I know as a consultant, when we're recommending to clients different platforms, we want to see that the platforms we're recommending, before we recommend them, that they have some heft, they've got some market share. We don't want to be certainly at the first, but even a smaller market share company, we might hesitate before recommending them. So seeing that they've got significant assets is important. Now, there are another couple of things. We've got a number of demos over the years of Addepar. One of the things I wanted to point out was their ability to support multiple legal entities. So you can view the holdings of a client by which ones are in different LLCs, and certainly higher net worth clients might have multiple legal entities like LLCs that are holding different investments, holding companies, trusts, and so forth. I've been monitoring Addepar over time. They've built out their platform, as I mentioned, from just reporting and data aggregation to include proposal generation, billing. They acquired portfolio rebalancing engine Advisor Peak a few years ago. So they've really got a full featured platform. Adipar has raised over $500 million over 7 investment rounds. The most recent one bringing in $150 million in 2021 from D1 Capital. If you want to learn more about Adipar, go to Adipar with 2 Ds, ADDEPAR.com. I think we're up to our 5th story. Number 5, Pantera raises $60 million, bringing their total funding to $160 million. Anonymous source close to the company has valued them at over $500 million. That's half a unicorn. Congratulations, Pantera. Now, this firm was previously known as FEX. They just changed their name in 2022 and pivoted, and they refocused from marketing a platform that serves as a fee comparison tool to developing software to help financial advisors manage workplace retirement accounts and other held away assets. That was a brilliant pivot because I wish I thought of it. No one else is doing that. Advisors have always, or some advisors have always given advice on held away assets such as 401ks or other retirement assets, but it's been verbally or an email, and the client has had to go in and make the changes. So if the advisor said, I don't like this mutual fund you're in, you should swap it out for this other mutual fund. The client had to go back, or the client had to take that information, go to their own account and make those changes. And who knows how often they would do that or even do it right. So what Pantera does is enables the advisor to log in using the client's credentials and make those changes and do those trades in the client's employer-managed retirement accounts. The firm, according to CEO Yoav Zorel, their revenue has quadrupled since 2021. They're headquartered in New York, but 65% of their employees are based in Israel. Yes, Herzliya. We love firms based in Israel. Now, they plan to expand their R&D operations in Israel and recruit more people for positions in cybersecurity, software engineering, data analytics, and product management. All good things to do with money, and I wouldn't be surprised if they made an acquisition or two. The funding round was led by Iconic Growth, a family office which provides wealth management services to high net worth clients, including Mark Zuckerberg, Sheryl Sandberg, Jack Dorsey, and Jeff Weiner. Now, some people have complained or knocked Pantera because of the price. It's around 30 basis points. But if you want this functionality, you're going to have to pay for it. There has been also some other issues with regulators looking into their use of clients' login information. Washington state regulators recently came out saying that Pantera could be breaching their user agreements with the 401k custodians by receiving and holding client logins. Tennessee regulators also raised concerns. However, I know, according to the article, advisors feel that this potential violation of terms of use concern shouldn't be an issue, and I agree that it's no different in how other popular financial planning and account aggregation tools access these accounts. Everyone is doing this, including Morningstar's Bio Accounts, Plaid, eMoney. So everyone's taking client. I mean, we're seeing less of it. Also, InvestNet's Yodlee. We're seeing less and less of what's called screen scraping, where they're taking these the login credentials and logging in directly, and there's more direct feeds, especially from these data aggregation tools, but it's still being done. So whether Washington State or Tennessee can actually say anything about it or make any regulations that would block this, we don't know. I think they would have a tough time considering how many other firms are doing the same thing. Pantera has been really knocking it out of the park with integrations and with partnerships, signing up big firms to use their platform. They recently signed Cap Trust to use their platform for 401k management. Cap Trust has over $800 billion in assets, 2/3 of it non-discretionary. They're one of the largest retirement plan advisors in the space. Commonwealth Financial recently picked Pantera for 401k management. I spoke with their head of wealth management a couple of days ago. It's not rolled out yet, but they are very excited about it. And a lot of reasons why these broker-dealers and very large RIAs are not only excited, but looking forward to bringing Pantera is not only to make more holistic management and make it easier to help advisors handle these 401k and held away accounts, but it's a big revenue increase because you now can charge basis points on these held away assets that are not at your custodian, that aren't under your AUM, but you can charge either. I've seen some advisors do half their standard fee or even the full standard fee because now they're directly trading it. What's the difference? Whether your custody or not, you're still directly managing those assets. So huge revenue increase for some of these firms. So I'm sure that then the 30 basis points doesn't seem so bad when if you're charging 100 on the additional assets or even 60, you're still doubling you're still making 100% profit on those assets. You can hear more about Pantera on our podcast and on in our blog. We did an article in April when Pantera announced integrations with InvestNet and AssetBook to enable direct trading 401k accounts. That's April. You can check out that article on the WealthTech Today blog. And on our podcast, we had Dave Goldman in episode 141 from Pantera. So you can check that out as well, or go to Pantera, Pontera.com. Our next story, I think this is number 6. InvestCloud appoints Jeff Yabuki as CEO. If you want to read more about this, check out RIA Biz article. I love their titles. These titles are so long. After 3 years and $2.5 billion, trying to make an InvestNet killer out of InvestCloud, Motive Partners goes owner-operator when CEO search comes up empty. Man, they just don't mince words in their titles. All right, so InvestCloud is a wealth technology platform that supports over 500 wealth and asset managers globally with more than $6 trillion in assets, both assets under advisement, assets under management. It's all assets under advisement, AUA, across this platform, and in services such as UMA estimate portfolio management, trade execution, accounting, model management, performance measurement, et cetera, et cetera. Now, Jeff Yabuki was previously the CEO of Fiserv, a global leader in payments and financial technology, a role he held from December 2005 through June 2020. Now, during Jeff's tenure with Fiserv, he led the company through a strategic transformation with significant acquisitions and divestitures, including the $22 billion merger with First Data. Fiserv nearly tripled revenue under his leadership, increased operating margin and earnings, and achieved total shareholder return of almost 1,000% through the end of 2020. Now, what's interesting, if you pull some of the stuff out of this RIA Biz article, the driving, my friend Andy Bashir was quoted. I'm going to pull out a couple things that he said about this move. According to Andy, the driving motive, no pun intended, the driving motive behind putting someone like Yabuki into the seat is that the exit strategy for this business has always been to IPO it. That's been the word on the street. It might not be a bad strategy, according to Bashir, if one assumes that they're looking to try and make an IPO happen in, say, the next 12 to 18 months, to put in an experienced public company CEO with a well-known and successful track record from an investor and analyst perspective. Absolutely true, 100%. I see that's why they would do that. Motive Partners and Clearlake Capital bought 88% of InvestCloud for $1 billion at the end of 2021. More from Bashir, what I've heard is that the focus will be on the core business, being Tegra, which is the legacy security APL business and managed accounts, portfolio accounting and portfolio management, which is the key revenue driver. Now, in the article, this is the RIA Biz article saying this, putting Yabuki in charge 3 years after buying InvestCloud and 8 months after beginning a CEO search looks like Plan B or Plan C. Once they went through the process of purging the loyalists, purging the founder and CEO John Weiss and his loyalists, they realized, according to Bashir, the business was actually broken, and they had to put some of their own boots on the ground. Now, InvestCloud was supposed to become the epicenter of a more than $2.5 billion roll-up of legacy software firms. They include Security APL, which they acquired from Fiserv for, I think, $600 million for 60% of that business, another $1 billion valuation business. They also bought a company called Finantex, which is a higher net worth dashboard reporting tool based really more based in the EU. and they bought legacy financial planning software vendor Naviplan and back office software provider, self-clearing provider Beta Next from Refinitiv. Now, Beta Next is an interesting business. They've got a huge customer base, some great names, including Ameriprise, LPL, Wells Fargo, Stifel, Janney, Baird, Wedbush. Uh, Even new players such as Intrustity are signing up at Beta Next. And from what we've seen, they have a very strong API layer, very good core transactional processing. There aren't a lot of competitors in this space with this depth and breadth of capabilities. You've got FIS. Their API layer integrations maybe not quite as advanced. They've had some recent issues with conversions, which is not surprising in general. That's not an FIS problem. We've seen when you're converting to self-clearing, no matter what you're using, no matter which vendor you're using, Beta Next, FIS, the other big player is Broadridge BPS. It's complicated. We've done these before, and failure is just you're on the edge of a precipice the whole time. So I'm not surprised that FIS has had some recent issues, but going self-clearing is very attractive to mid-sized broker-dealers for the vertical integration and the great economics. They make money on custody, right? So which they didn't have before. It's another revenue stream. And firms like Ray J and LPL are self-clearing, so they can bring on RIAs and make money. Whereas other firms, if you're a broker-dealer and one of your if you're a W-2 broker-dealer and your advisors leave to start their RIA, you'll lose money. If you're an IBD and you've got RIAs who are affiliated with you and they decide to go off on their own and they don't want to be affiliated with you anymore, you lose the money. But if you have custody, you can kind of keep that and you can launch your own RIA network, as I believe firms like Thrivent have done. Osaic, the former advisor group, has done this. Cetera has done this. They're launching their own RIA networks to try to keep that money in-house. Now, what's interesting also about Beta is it's a very sticky business model. So now this is part of InvestCloud. They own Beta Next. It's like core banking, so it's similar in that respect. It's the last thing you want to mess with. It's very difficult to get new customers. It's a long, long sales cycle, and it's hard to. It's a plug and play. You got to unplug someone to plug your system in. So it spins off a lot of cash with good margins, but it's slow growth, probably like single digits, and the revenue is based on trade volume and market cycles. So it's also a barbell-shaped market. They're all really, really large clients or really, really small clients, not much in the middle. So that's the Beta business. And APL is very similar. Core portfolio accounting, portfolio management, also the last thing you want to mess with. Very hard to replace. Long sales cycle, difficult to make a case why they need to change. Inertia is a tremendous not value. It's a tremendous benefit to the established players, the incumbents, inertia, because it's so hard to move off of a portfolio accounting, portfolio management platform at the enterprise level when you're talking with these large firms, and the growth is slow. So, it just seems to me you're buying a bunch of well-established but very mature, slow growth businesses with long sales cycles. That's not a business that's it's going to be easy to IPO and convince people to buy into, right? Not that they're bad businesses, they're good, but where are you going with it? How are you going to goose this revenue? How are you going to double, triple the revenue on these companies? And I think that's the problem that these firms have had when they acquired them, that they thought they could simply come in and double, triple revenue, which is really what you want to do. Is you're going to be paying those kind of multiples, billions of dollars. You want to return, and it's difficult to do. This is what we do all day at Ezra Group. We have, just full disclosure, before Motive acquired the Fiserv APL, security APL business, which eventually became Tegra 118, we had done a lot of consulting for that business on strategy. So we know a lot about the platform. We'd done deployments of APL at numerous broker-dealers, both deployments to and blended deployments from. So we'll go in either direction, whichever we think is best for our clients. Sometimes moving to APL is great. Sometimes they don't like APL. They want to move away from it to something else. Happens all the time. So we know a lot about it, and it's a long process. It's not easy to do, and it costs millions of dollars for these larger companies. And so seeing Jeffrey Buki come in, we hope that he has great success. It's going to be difficult, especially after the whole management team was fired, right? That does not happen. Certainly not in our business, but in almost no business, especially a company that's been around for over 10 years, 15 years, and all this money invested in them, that they just shoot the entire executive team, 6 people out the door at the same time. I don't have any details or insider information. If I did, I couldn't tell you because we're still under NDA from, working with these guys years ago. But it doesn't bode well. That doesn't say, hey, we had a disagreement about or about your priority or about your strategy. That tells me something else was going on. I don't know what it is, but it's not good. So Jeff's got a hard job ahead of him. I know they've had a number of layoffs last year and the year before. A lot of people were let go. Whenever there are layoffs, no matter what company it is, we get calls here at Ezra Group because we know everyone. I have a lot of friends who were there and who were laid off, people I know. We brought on some of them to our firm to help with some other projects. So, in some respects, we're happy when they're laying people off, but it's never happy when you get laid off. And also, those businesses require people to run. And you're laying off. I know the people they laid off were ones with serious institutional knowledge, the ones who know where the bodies are buried and know how these platforms work. So it seems like Ibuki might be inheriting a skeleton company where he's got to build it back up from scratch and quickly if they're expecting to IPO at any time soon. Well, that's my long-winded explanation, description of or opinion on this particular story. Again, go to riabiz.com to read more about that story, or go to investcloud.com to find out more about their products and services. Flourish annuities platform. Flourish platform launches aims at $350 billion annuities market. So Flourish, which was originally called Flourish Cash, has now launched an annuities platform. They also have a crypto platform. So their aim is not only to provide a marketplace of fee-based annuities for fiduciary RIAs, but also to solve for the operational challenges of implementing annuities and their notoriously burdensome paperwork through streamlined and automation of application processes. So we like what Flourish is doing here. They've built a number of successful businesses. Their Flourish Cash Management platform is very successful, with, I believe, thousands of RIAs using it to be able to deliver better interest rates to their clients by automatically moving money between different bank accounts and also breaking it up into smaller chunks to take advantage of FDIC insurance. So that platform is doing well, and annuities was something they wanted to get into to make it easier to acquire for RIAs to acquire annuities because it is so notoriously hard. While there are companies like DPL that automate and outsource the acquisition of annuities, there is still some opportunities for firms to build tools that enable RIAs to directly acquire annuities cheaper, more streamlined, more transparently. Envestnet also has their insurance marketplace, which connects advisors with annuity carriers and providers. So there's a lot of opportunity there for advisors to be able to bring annuities into their platforms, be more holistic, offer these tools. I know the financial planning software applications, all the top three, Money Guide, eMoney, and Right Capital, all show forward projections of how an annuity could help clients close some expense gaps in retirement. And being able to connect those to actually buy the annuities inside the same process, I think, is the next step, which is going to give firms like Envestnet a leg up since they've got the insurance marketplace, they've got Money Guide, so you can plug those all in together and do that acquisition. So Flourish is looking to get a piece of this as well. So you can find out more about Flourish at their website, which I believe is flourish.com. Before I say that, let me double check. Yes, flourish.com is the website for their cash management and their crypto and their annuities platform as well. Okay, next up on the news is Right Capital launches something called Right Flows. Now, Right Capital is one of the top three financial planning software vendors. Their market share has tripled since 2020, becoming one of the top three, right behind eMoney and Money Guide Pro. Now, this Right Flows is a workflow tool. It allows direct client collaboration, claiming to help advisors manage and assign steps in the financial planning process to team members and clients. So this could be a powerfully tailored workflow tool, but do advisors really need another workflow tool when there's already other things within the CRM and other tools? Will other tools just copy and create their own embedded workflows? So here to talk more about this is an expert on workflows and expert on RIA technology and operations. It's Kristen Schmidt from RIA Oasis. Hey, Kristen.
Hi, thanks for having me.
I'm glad you could be here. We haven't talked on the podcast in a long time. So we're talking now. You're joining us for the news. And this story is Right Capital launches something called Right Flows, a new feature. So what do you think are Right Flows? What's your thought about that?
Oh, so many thoughts. First of all, congratulations to Right Capital for building something after reviewing it and playing around with it. Building something that is finally easy to use and makes sense to advisors. So I think on behalf of all of us everyday users and people who have to train others in how to make this sticky inside your firms, I think it's a great tool. I think there's a bigger conversation that all of us are probably having amongst ourselves about, well, gosh, where do I do workflows?
Mhm.
I think that's the biggest challenge because, as you know, I'm a CRM implementer and expert and best practice person, and it's kind of what runs through my veins. And so in my world, if it's not in the CRM, it didn't happen. So if you play off of that theory or that mantra for a second, it gets a little challenging when we start thinking about a financial planning system that has workflows. Possibly firms are using workflow tools like Hubly. Well, now my workflow is in a different system. We have firms that are sometimes going to Asanas or project management tools. So I think that it adds another layer of where do I write my workflows? So I think that's the bigger conversation for me and that I'm having with a lot of advisors. I think the other piece of it is, even if you write the workflows and you feel organized, here's our new financial planning workflow and it's in Right Capital as an example. I think the challenge is all the tasks that you're telling people to do, you're telling your financial planners to do this and your client service people to do this, all those tasks, the to-dos, are in Right Capital. But I also have a bunch of other stuff I need to do, and that's in my CRM. So I think there's a challenge for RAs to manage all the things I'm supposed to do and be accountable for it all. And we like having that in one system. And technology today on the RA side is struggling to give us that. I'll give you a good example.
Why do you think it's struggling?
It's a struggle because, in my opinion, all of these technologies want you living in their systems. And I don't blame them. They built something and they want you to be inside it. And that makes sense. But when it comes to the daily events that's happening in your RIA, the challenge is, number one, I don't live in one system all day. And number two, I need to run reports telling me what everybody is doing, needs to do, or already did, right? I don't want to run reports in 4 systems. So what do we end up doing? Exporting, putting it in Excel, screenshotting. That's what a lot of our client service people are doing for our advisors and planners on a literal daily, sometimes twice daily basis. I'll give you an example. Hubly, great workflow tool. I am a huge advocate for it in a sense of making workflows simple, and the visual is beautiful. It's color-coded, it's simple, it's siloed. Great. I often say it has that visual of, if you remember Trello, you had boxes, you move things everywhere.
The Kanban board.
Yeah, exactly. And that's a lot of how people need to see things to take action or know where they're at in a process. Love it. The challenge is the integration into CRMs such as Redtail or WealthBox. The integration, all that it does, it links your records together. So your client records are linked together, which is great. But when it comes to those workflow tasks, it's all in Hubly. After the workflow is fully completed, Hubly sends a note to WealthBox and Redtail that says this workflow was completed. So the integration is lackluster in a sense of the everyday things we need to do. If you're an RIA using Hubly and Redtail or WealthBox, your staff are using two systems to manage what they have to do. And that's the challenge that a lot of firms are facing. So then let's take it another level and say, I'm talking to executives of large firms that are saying, I would like a dashboard. We're all using that phrase lately, right? I want a dashboard. I want to see everything that's currently in progress. I want to see things that are overdue or pending. And I want to give credit to people for all the things they did. I also want to see if my staff is at capacity, right? So for example, my assistant, Sarah, says she's really overwhelmed. She has a lot of work to do. I want to quantify that. Let's look at all these things we assigned her. Is she really at capacity, right? It means you run two reports every single time and you try to morph them together in their priority and their status. And it's possible, firms are doing it today, and it's very possible, but it means you need more humans and more attention to detail every day. So coming back to Right Capital, I think that it's a great tool and idea, but I think there's still work to be done with firms who want to adopt that. Where does the workflow live? Where do the tasks live? And how do we meld that together to see it all in one place? And that's still a to be determined, I think, in the scope of where RIA tech is today. And what I do every day in helping these firms gather all of that and create efficiencies.
So Right Capital is claiming that they're the first financial planning workflow tool. Is that true? I mean, do you think
that is correct? That is correct. So, and that's where this can also get a little bit confusing. I'll give you an example. eMoney has allowed tasks to sync to and from their system. So for example, they have an integration with Redtail where you can have activities sync in. You also are allowed in eMoney to task your clients if you want. There's a lot of controversy over that, to be fair, about whether we want to actually send our clients a task or politely ask them to do something in an email, right? I think it takes a certain personality of a client to not take offense to being tasked. Some clients say, oh, this was great. I didn't have to remember anything. It's all there. And other clients say, I feel like that's what I'm paying you for, right? Can you imagine if your doctor gave you a task, right? So there's a balance, but eMoney has always had those features. Right Capital is allowing these workflow tasks to be seen or assigned to your end client if you want, which then makes clients and advisors more sticky to that client portal. But the actual flow being written in a financial planning tool, yes. No other financial planning tool has that today.
Yeah, I hear you.
I'm just going to say that's because traditionally, and I think best practice is workflows live in the CRM, not in your ancillary tools. Because I can't help but think, okay, well, now I want to be in my estate planning tool. Do I need an estate planning workflow in my tool? And now now I'm going to work in my tax planning tool. Our workflows going to live there? And now let's say Craig Iskowitz is my client. We're working on estate planning. We're helping him with tax analytics, and we're opening 529s for his kids. I've got workflows in 3 places. Someday, I say with a question mark at the end. So I think that's actually the challenge is I love that Right Capital is encouraging firms to be process driven and to say, what are we doing in Right Capital for our clients? That makes sense. And I'm pushing clients to do that all the time when I'm working with RIAs. But there's a bigger world out there of all the things we do beyond just the financial plan.
Yeah, and I get when you say that all vendors want you to live in their tool. I wrote an article about that probably 8 years ago now, that every application wants to be the hub. They want to be the central location for all of your activities. But as you said, things are spread out, and it's hard you just can't stay in one thing all the time because you've got data spread across multiple applications.
Absolutely. And if we're really going to break it down, it's because we're not offering one service in which our business would live in that tech. Okay. If you are investment management centric, you're still living in 3 or 4 systems. But if we're being honest, you're really living in your portfolio management system that has a trading and rebalancing tool. At the end of the day, that's your core system. It's your hub, right? But what about firms that are often offering financial planning? Like I said, estate planning, tax planning, health planning, right? Life planning. There's, the consultant words are, to be honest, they all mean the same thing, but we're offering different services. So it's funny you say that, because in the article that you did 8 years ago, it has a lot of relevance to that's why we need all-in-one systems, right? And that's also why these all-in-one systems, in fact, I just wrote this note knowing that we were talking today, and I wrote, all-in-one is really struggling to be defined.
Well, hold on. That's a whole nother article I want to write.
You're right. Sorry. Whole nother podcast. Yes.
Let's do that at another time. But
yes.
So I want to wrap this by saying that people can find more information about Right Capital's Right Flows by going to rightcapital.com. And we're going to take a break and go to another article. Then I'm going to bring you back. We're going to talk about the T3 conference later.
Sounds good.
Okay, we're getting towards the end of the news. Next story, we're going to be talking a bit about the T3 Inside Information Advisor Software Survey for 2024, which is an annual survey run by T3. Joel Bruckenstein partners with Bob Vires on that survey every year. And it was released at the T3 conference last month in Las Vegas, which happened to be the 20th anniversary of the T3 conference. If you want to download a free copy of this survey, you can go to t3technologyhub.com. And I'm bringing back special guest, Kristen Schmidt, to talk about some of our thoughts about the survey and some of her thoughts about the survey. We use this survey a lot at Ezra Group in our research, because we get hired by a lot of wealth tech vendors to help them with strategy, help them with competitive analysis, to help them with a go-to-market strategy. And we reference the T3 survey a lot for different areas because it's directionally accurate, I think, in terms of a lot of which way the market is going around different technology, even though it isn't statistically, scientifically, doesn't follow statistical methods, because they're not going out and saying we're going to find the participants. They let anyone respond, then they try to clean it up.
Right.
But it's still, I think, a very useful data point in an industry that lacks a lot of good data. So
we're
Kristen,
craving it.
All right. So now, Kristen, what are your thoughts on the survey?
I think we need to make sure we ground ourselves with who's responding to the survey, right? And what is the scope of the type of business that they have? Because a lot of times when advisors and planners are looking at a survey, I always give the tip and say, where are you in these responses? There's nothing worse than comparing yourself to a firm that is bigger than you, smaller than you, or doesn't offer services like you do. So if we go, real simple, there was close to 3,000 people that responded to the survey. And I think that, like you said, we're craving data. So it's a lot. It's great to see. I think when they try to break down who's responding, they had 2 factors that I think are really good benchmarks. One is the revenue of the firm. So 25% of these respondents had revenue of 500 million or under.
500,000.
Sorry, say it again.
500,000.
God, I fucked it up a second time because I had my million in there. But poor Alana, I'm sorry.
You can just keep going next time. You don't have to start over again. We can just say you made a mistake and edit. And just all right. So we start that sentence again.
25% of firms that responded had $500,000 in revenue or under. And then you have another 20% of firms that responded that had anywhere between $500,000 to $1 million in revenue. So I think that's a good benchmark for advisors and planners who are looking at this data to really say, is this me and is it representing me? Also the type of firm. 56% of firms that people that responded were a part of a fee-only firm, and about 40%-ish were duly registered. So I think it's fair to say that when you are an independent RIA or you're a hybrid RIA, a lot of you are represented within this survey for sure. There is an area as they start to break down all of the questions they ask and what it means when they get all of their results. They called something market utilization. And I thought that was an interesting term, Craig, right? Mm-hmm. And so to me, what that means is how much are firms utilizing this? And I always like to remind people, just because you own a license for technology does not mean you're utilizing it to its best capability. How many times do you and I hear as we're working with clients in different projects that they say, well, we have a license or we have a couple licenses, but we only use it once in a while, or we haven't used it in a long time. So I think the utilization factor of where they're trying to identify how much is a firm using their technology, it can be a little interpretive. Where they noted some rises in that utilization is estate and tax, which I think are some really good points. We're seeing estate planning technology tools as well as tax planning tools being utilized a lot more. Why are we seeing that? Because firms are broadening their services to try to bring value to their clients. Back in the day, we used to just do investment management and walk in with our performance reports, and it's not enough anymore.
Right.
And when you state the fact of, I do wealth management, people on the street don't know what that means. They need more tangible. So we're starting to see advisors say the core offerings that I offer to my clients are investment management, financial planning, and those might even be switched. They might be financial planning centric. And then there's what I like to call the a la carte services, depending upon their needs. And so that's why that technology, I think, is really taking off. Interestingly enough, there's some declines that were stated in T3 survey. Now, the declines are less than 10% as I give you a little bit of a list. But I work in all areas of tech, but as a CRM expert, I was surprised to see that CRM was in the list of a little bit of decline. Along with risk, that doesn't surprise me. And on your side of things, Craig, lead capture and digital marketing had a percentage decline, which I thought was interesting.
Right.
Have you seen that?
Means?
Yeah, I think it's the idea of utilizing tools for your own lead capture and digital marketing. And I will say on my side, I'm getting less inquiries about firms interested in leveraging the tools or finding new tools to do that. I think that firms are still relying a lot on organic growth or mergers and acquisitions in order to grow. And that lead capture and digital marketing tends to take kind of a third seat in order of how they're approaching it. Now, there are a lot of successful firms that have great digital marketing and lead processes. But when it comes to deploying separate tools for that, it's a lot of work and upkeep, and sometimes doesn't hit the budget or people resources that are needed. Do you see that in what you're working on?
I think it might be the difference in the size of the firms we work with. So we work with broker dealers and enterprise RIAs, where I think you're more the mid-tier RIAs. So
correct.
And it's I think it's a difference in how they market. That larger firms, true, they also do M&A, but once you get past a certain size, and Michael Keats has pointed this out in his he did a couple of talks last year that I caught around on advisor marketing, and how at some point you can't scale with referrals anymore. You have to go to a strong dollar-based marketing plan, which has to have some sort of digital capabilities. So I think for the larger firms, they are definitely still interested in some sort of digital marketing tools, whereas smaller firms, maybe not so much.
I would agree. I also think that there are some smaller mid-sized firms, especially, you're absolutely right, the firms that I work with as well. It's scary to put something like that in place because you have to have the staff and the processes in place to receive all those leads and to receive all of the attention you get from digital marketing. So sometimes it's almost a catch-22 for these firms where they say, we would love to deploy a tool to help us do this. But once those leads start coming in, we don't have the manpower or the workflows and processes to drive the efficiency to get all these people talked to and onboarded and, feel the love that they deserve from our firm. So I think lead capture and digital marketing requires firms to make sure that they have their business running like a well-oiled machine. And a lot of the larger firms have worked out those kinks, put the right people in place, and put the money into the people in the process to be ready for the influx. And there's nothing worse than being a firm who is ready on the front end, but isn't ready on the back end.
Oh, yes. Yeah. And we see that a lot as well. Again, we're not a marketing firm either, but we're a technology and operations firm, and we help these companies figure out how to handle that data. They've got to do the strategy, what their marketing strategy is going to be, what their marketing content is going to be. But getting the data is something we do, building those systems and building those connectivities and those integrations. As you said, the leads come in, the prospects come in. Where are they going? How are you tracking them?
Yeah.
And then how do you convert a prospect into a client? Is that a smooth process? It's smooth if it's already in the CRM. A lot of firms have a separate database for their marketing system. So if you have digital marketing, they have one database of prospects that they're sending out emails to or pushing content to or tracking. If it's a more complex marketing platform like a HubSpot or SharpSpring or something similar, that's got its own CRM and database built in that you're working with. And that may be better for some firms because that's a very different CRM process, marketing CRM versus advisor CRM, right? An advisor has a very different interaction with a client. Mostly it's clients, and some prospects, obviously, but whereas the marketing people are only talking to prospects.
Absolutely. And then when do they cross over, right? So we have those conversations all the time of, I call it, when are they advisor CRM worthy, right? So what's that qualification point, or what's that marker where they now move into that system, versus the opposite would be those leads that we have, they're cold leads, we're dripping on them, but they're not taking any action. They haven't shown any interest. They're not doing the clicks. So I agree with you. It's a very challenging effort, although it can be exciting for sure. Another area of the survey talks, which this is usually the most interesting for me, which is satisfaction. And I will tell you, most advisors and planners, if you're reading any of these surveys, and I think we need to give credit to other people, Michael Kitces does his as well. And there's other surveys that do come out throughout the year. The custodians also do great jobs of giving their market analysis by surveying advisors. But at the end of the day, we're reading this stuff because we want to know who's happy and where are they happy. Okay. So who likes their CRM? And if they like their CRM, maybe I'll like that CRM, which, by the way, that's not a thing. Okay. Just because you like something does not mean I will like something. And
everyone who's listening, just so you know,
just so you know, that's not a thing, right? And it's not. You have a very high chance of liking a lot of things about technology that other people use, but will you be happy enough to move everything out of one house into another? Probably not. And so when we talk about satisfaction, I think there's so many variables that go into it, it's hard to quantify. So I think this survey actually proves that point, because satisfaction rates barely changed, not even more than 0.5% within the past 2 years, which I think you could look at that a couple of ways. One is nobody is skyrocketing with their satisfaction. Now, surprise, nobody's ever happy in our industry with their tech. It's a hard space to be because everybody wants different things. So you could look at it very positively and say, yeah, but it didn't go down any either, right? It stayed even keeled, and every tech vendor is at least doing the bare minimum. I think the challenge with satisfaction in ratings is everyone is dissatisfied for different reasons. So I think if we were truly going to do a survey, what I would love to do someday is to do a satisfaction only survey to really dig into the whys. And is it a tech issue or is it a business issue for these advisors, and start really to figure out how could the tech help you with your dissatisfaction. Because I think that's ultimately, I mean, to be honest, as a consultant, that's why I have a job, right? They're not happy or they're not moving forward. Therefore, we must change something. It's very easy to point at the iPhone, my computer, my camera. It's very easy to point at the physical things. But I think when you look in the mirror, sometimes it also has to do with your people, change management, and your processes. So satisfaction is a tough one. They touch on it in here, but I have a dream of wanting to do more satisfaction ratings in the industry that are more driven towards challenge.
For my comment there, this is secrets. This is a consulting secret. I really shouldn't be saying this.
Uh-oh.
So here's so everyone take note. This is a consulting secret for every RIA and broker-dealer out there. Whatever technology you buy, you're not going to be happy with it after you buy it. Most likely.
There it is.
Because once you buy it, then the shine is off the apple. You're not looking at it debt anymore. You're realizing you find data you didn't know you had that the system doesn't work with. You find processes you didn't know you had that the system doesn't support. You realize that you have the rule of thirds with your advisors and your operations team, which is true with any technology or any change in any business generally, but we use it for technology. A third of the people are going to love it. So happy you changed. A third of the people are going to hate it. Can't believe you changed. And a third are sort of, whatever, we'll do whatever. So you have to go after those third in the middle, win them over to your side. So you got 2/3 and then beat up the 1/3 remaining that they either get on board or get out, like get them on the bus or get them out. And I'm serious about that because if they're still there and they hate the system, they're going to sabotage you. And it's not going to work and you're going to be wasting a lot of money. And Kristen's nodding her head. She's seen this before.
It's spot on.
Get the right people on the bus.
Absolutely. I mean, we could talk about that for a whole nother session,
right? That's a whole other article.
It's a whole other article, but I think also the people who are shopping are not the people using it every day. So I think, one golden nugget to give RAs and owners of businesses, I think, is all of your users, or at least a core team that samples different areas of your business. So a financial planner, an advisor, a client service person, an operations person, they all need to be telling you what they like and don't like. And they all need to be a part of that buying process, because how they use it often defines those thirds that you just talked about. And besides that, personality, right? People don't like change. It is a change management project, not just a tech project, if we're being fair with ourselves.
You said a mouthful there, Kristen, and we got to wrap. This segment's already 20 minutes long. Thank you for being here, Kristen. We're to talk about the T3 Tech Survey. As I mentioned, to the T3 Inside Information Software Survey. You can go to t3technologyhub.com to download this free survey. Thanks again, Kristen. Really appreciate being here.
Thank you.
All right, we're up to one of my favorite parts of the news. It's the Advisor Tech Map and integration scores. We're going to go through quickly some of the applications that were added to the Keitz's Ezra Group Advisor Tech Map that I work on with Michael Keitz's. Every month we meet and we look at the queue of applications and vendors that want to be added to the map. Some make it and some don't. And just so you know, if you're out there and you want to be on the map, you can do that. You want to send your email not just to me. I mean, you can copy me, but I'm not directly the person who updates the map. You want to send it to Erica Mito. So if you and she's Erica@Keitz's.com if you want to be added to the map. Then Michael and I will review it and decide whether you get on the map or not. And firms that if you don't sell software, if your business is not, if your revenue generating part of your business is not software, you're probably not going to get on the map. I'm not saying you won't, but it's unlikely because the map is designed for independent financial advisors to pick software. So you want to compare software versus other software. And we do get firms like if you're a TAMP, you're not going to get on this map. There will be other maps for TAMPs. If you are running a marketplace, either like an alternative investment marketplace, you're not going to get on the map. It's not for marketplaces. It's not for TAMPs. If you are a service company, if you do trusts and wills as a service, for example, or estate planning as a service, that's how you make money. and you also have software not going to get on the map. All right, that's the disclaimer before we start. Looking at companies that did get on the map and will be on the map for the March version. Boosted.ai is going in the investment analytics category. Pretty straightforward, nice clean design, drilling down into different equities. They've got besides just the standard fundamentals and charting, they also have some pros and cons that they've put in there about the particular stock, strong product and service or decrease in total net sales as a con, for example. So another tool in the already crowded investment analytics category, Boosted, Boosted.ai. And my prediction is they will lose the .ai at some point because it's just overdone. Next up, Life Hub. Life Hub is at, I'm sorry, this is Income Labs. Income Labs has a new product called Life Hub that is a one-page interactive dashboard of a client's financial picture. They've already got one logo on there as well, but they're going to get another one, I believe, on the map. So you can check them out at incomelaboratory.com/Life Hub. Next up is Jump, jumpapp.com. And this is another client meeting organization tool. We're seeing an explosion of those lately. They're going to go into I think the client meeting support category. They allow you to turn conversations into tasks and notes and compliance records. They claim they've got AI, as does everyone now. That's table stakes pretty much. They think they can save time organizing meeting reviews. So you can check them out at jumpapp.com. Next up is Jacoby, also in the investment analytics category. Technology for multi-asset portfolio design, analytics, and client engagement. Okay, it's Jacoby with an I, Jacobi, strategies, one word.com is their website. They target asset managers, investment consultants, asset owners, and wealth managers and RIAs. So that's just one of the target client segments they support. Again, clean design, what you would expect from investment analytics on equities, risk and return objectives, risk factors, stress testing, contribution to volatility by asset class, contribution to volatility by risk factor. I'm just looking at some screenshots here, so you can check them out. All right, finally, notice something that's not going into investment analytics. Powder, sales enablement, in the new category we created a couple months ago called sales enablement. Powder, F-I, P-O-W-D-E-R, F-I.com. AI sales, shock, AI sales co-analyst for wealth advisors. Drive a collaborative and efficient proposal with your prospective clients. So they've got proposal generation, automate data gathering, demonstrate value, accelerate conversion, speed up your workflow with institutional grade AI. Not sure how those two are related. AI doesn't necessarily speed up your workflow. Automate laborious data gathering. That we like. There's always opportunities for data gathering, demonstrating value, accelerate conversions. So they've got pricing plans. Looks like it starts at $200 a month per user for the basic platform. Powderfi.com in the sales enablement category. And are we done yet? Nope, we got a couple more. FinSpace. And that's, I'm sorry, FinPace. Oof. F-I-N-P-A-C-E. Automation for financial advisors. Now, I don't have where they're going. I'm guessing this is going in workflow. Where are we here? We want the my list of vendors that are going in FinPace. FinPace is going into, it doesn't say, but I'm guessing they're going into, you know how tedious managing customer relationships, onboarding, and compliance can be. FinPace automates the heavy lifting of these tasks, freeing you for better things. Automation beats workflows. So I'm guessing it's a workflow management tool. onboarding, gathering data. So there you go. So that's where FinPace will be. Next up, due diligence works. Due diligence works. Just like it's spelled, just like it sounds. Due diligence works.com. It's a long name, but at least it's exactly what they do. And this is compliance. Pretty straightforward. They are making some waves in the industry. Due diligence works is they've got a pretty decent product. They've also been doing some hiring as of late. They've got Reg BI tools, ERISA 401k rollover tools, RegTech tools. So they've got a lot going on there at duediligenceworks.com. And they're going into the compliance category. And just saying, they hired Kevin Hughes, my good friend Kevin Hughes, formerly longtime employee over at leader over at Money Guide Pro. He's now the Chief Growth Officer for Due Diligence Works. Congrats, Kevin. Guys are doing really well. All right, next up is Equilar. 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 And they are going to the prospecting category. This is a new category we added a couple of months back because there are just too many tools that are really just prospecting tools. And I think we were lumping them into the category of digital marketing when they really should be in a separate category. And another thing to know about the map, we get the question all the time, when do we create new categories and why? And it's usually when there's enough new products that they stick out from the existing category. And the minimum number is 3. That's the number Michael and I have agreed on. So we have to have 3 products, although I see there's already another one that's here for 2, but we said 3 would be when we would create a new category. So when there's an existing category like digital marketing that has 3 applications that are in prospecting, at least, boom, that becomes a new category. Now we have prospecting under business development. You can see it's the upper right-hand corner of the map under business development, which is orange. Prospecting, then below that, advisor lead gen, then below that, digital marketing, and then sales enablement. So Equilar, Equilar, under prospect, another prospecting tool. A lot of these tools, I mean, I'm not sure how many more of these tools we can support, but they're all out there looking for money in motion. When people get equity awards, their compensation changes, they sell a company. Now, I can't imagine if I ever saw Ezra Group, how many emails and LinkedIn messages I'm going to be getting from advisors who are using all these tools and just going to swamp me with, hey, come over, talk to me about whatever you got going on. So I'm not sure how successful all these different tools can be, but they seem to have some nice interfaces. They're pulling in a lot of data. Hopefully, with the AI they're using, they can figure out how to form good LinkedIn messages, good emails, cold emails, and cold LinkedIn messages that could get these people to at least have a conversation with the advisor. So that's where I see AI being able to provide some value here. All right, moving on. PureFacts. PureFacts is a Canadian-based company that has done some acquisitions. They recently acquired Extiva, which is a US-based firm that offers advisor compensation systems. And PureFacts' main solutions are around fee billing. So I believe they are in the fee billing category. Yep. So that's PureFacts in advisor fee billing. They've got, again, most of their clients are in Canada, but they're looking to break out into more into the US. And they signed a big deal with Pershing. The Wove platform will be using PureFacts as their billing solution. So that's a pretty good vote of confidence for PureFacts. Again, they are at PureFacts, yeah, not PureFacts.com. All right. Close this. We'll close this. Are we done yet? We got some more here. Yeah, I think that's it. Finny. Finny. Finny AI. Whoa, another AI name. Finny AI. FINNYAI.com. Another prospecting tool. Take the guesswork out of prospecting. prospect prioritization, similar to Catchlight, prospect identification, customized outreach campaigns. So I got some marketing there. And you can, another prospecting tool, Finny, FINNYAI.com. Oh boy, we got some more here. This is a big month. Can't even say this. Philanthro. Sorry about that. Sorry, Philanthro. You gotta get a name that's easier to say. Philanthpro. Philanthro. Not my first choice of names. But philanthropic, it goes under specialized planning, other, charitable. So that's where we're putting philanthro. Yeah. So we don't have a charitable giving category yet. Maybe one coming soon, because there's also Charity Vest as well. But again, it's only 2. We want to have 3, but I guess we'll have a third one at some point, and we'll have a charity specialized planning. So they're bringing the power of planning to your philanthropic clients. Philanthro. Okay. And okay, we're at the end. The last one, Tiffin AG, another Tiffin application. And it is also in prospecting. Less art, more science, delivering enriched data for actionable intelligence using proprietary algorithmics and AI. They bring in data together, organize it, engage it, plug it into your CRM. You can score your prospects, also similar to Catchlight, CRM integration. You can do some influencing with them, content for them. Yeah, another prospecting tool. We're loaded with prospecting tools this month. Tiffin AG. It's TIFINAG as in George.com. You can check them out. All right, that's it for the map. All of those applications will be available, whether we'll have their integration scores on EzraGroup.com. You can check out the integration scores for all of those companies as well. And if you are a company, a vendor, an application vendor in our space, and you're on the map, and you have a score that's at least 6 or higher, please reach out to us. We've just launched the Ezra Group WealthTech Integration Score Recognition Program. We are offering badges that you can put on your website and other marketing materials to certify that Ezra Group has validated your integration capabilities. Plus, there's a lot more. We're going to be doing quarterly conferences and having a lot of other research available to firms that sign up for the WealthTech Integration Score. Please contact us at consulting@ezragroup.com. All right, you've reached the end of another episode of the WealthTech Today podcast. Thanks for listening. But before you go to our website, ezragroup.com, scroll to the bottom of the homepage, and sign up for our newsletter. Once a month, you'll receive an email chock full of wealth management goodness, news, information, updates. You will not be disappointed. Thanks again for listening, and talk to everyone again next time.